Hi, it's Jim Yent from Golden Years Advisors, the home of the Kairos formula. It's March 15th in the middle of the month, and you may notice I got a black eye. In fact, I got a zombie eye. It's all red because a blood vessel popped. And it's not because what you think, Teresa hit me. It's just that blood vessel breaking. But speaking of zombies, we have several zombie banks that have come upon the scene in the last week or so. And in keeping with our March Madness theme, we want to give you a quick banking update. What started as something pretty simple, some cracks in the regional banking system, specifically Silicon Valley Bank in California, and then Signature Bank of New York, caused a run at the bank at both of those banks last week. And what happened was, literally by Friday, the government stepped in. The Treasury, the Federal Reserve, and the Federal Deposit Insurance Corporation, the FDIC, took over the bank, and over the weekend they announced that they're putting in safeguards so that by Monday morning, all the investors could access their funds. And what they did, the government, was they didn't use a small rifle, they used a large bazooka or missile and set up something called the Bank Term Funding Program. It was $25 billion set aside so that any bank that might be in distress, and it's the smaller banks, the regional banks where they're seeing this, they've created a backstop for them that they could access without taking any losses. Any of their portfolio that has losses would get redeemed at full 100% par value. In exchange for that, they'd pay the going swap rate to do that, plus about a 0.1% fee. So people ask themselves, how did this happen? How did this come about? Well, it was a couple things. First and foremost, we said as rates rose, the Fed was going to keep rising rates to crush out our disease, inflation, that we have. And we're going to give you an inflation update in a minute, but they're going to keep raising it as high as they can to make sure that they can get back to their 2% target. Well, on the chart in front of you, you see the steepest leftmost blue line is our current rising of federal interest rates. And on the bottom is how many months into it we are. And it's the fastest rate increase we've had in a long time by the Fed funds rate. If you look at the next two lines, the green line, that's what happened during the 1988-89 time period. Back then, it was the savings and loan crisis that rapid rate of rates accelerated. And then the second lighter blue line, the second most steep line, that's back in 94, 95. That's when we called, quote, the tequila crisis, where we so shocked the emerging market worlds that countries like Mexico had lots of problems. So we've said all along, the Fed's going to raise rates as long as they can. And the key goal was, wherever inflation was, to get that Fed funds rate higher than it. And then the Fed would feel very comfortable that they were winning, and they'll probably just hold the rate there. We said that's what they would do. They would pause unless something cracks. Well, we've seen cracks. Just to back up, back in the October timeframe, the British Treasury, it's called the Gilder, had such a crisis that the PM got ousted, the Prime Minister got ousted. A month later, we saw FTX, the cryptocurrency exchange, with a lot of fraud, go down and drag another bank down back then, Silvergate. But those weren't US problems, and they weren't major market problems, right? It wasn't until just this past week that we've seen it in the US, not at the big banks, because any significant bank goes through incredible testing, but at the regional bank level, we saw it happen. So we're seeing some cracks, and that's what's kind of spreading. So today, as we speak, we see Credit Suisse, a big institutional bank in Europe, which has been troubled for multiple years, to be very fair and honest. Its stock price has been plummeting over the last couple of days on fear that it might not be an ongoing concern. So that's kind of warning signs that we're seeing. I wouldn't say this is a redo of 2008 by any means. Our banking system is far stronger and far better in place than anything that happened back in 08. Plus, the problem is completely different. This is inflation that we're trying to kill, rather than people not paying their mortgages and things like that. So getting back to why did this happen, or why those banks? So interest rates rose, that caused the pressure. But the real reason why those banks failed was they're kind of outliers. This chart was prepared out of FactSet, tried to find similar small banks. So if you look, there's the names of the bank. The top two are the ones that failed. On the fourth column over, you'll see their market cap. These are all small banks. Most of them are single digits in the $1 billion of market cap. That's a small cap stock by any measure. And the largest one there is First Republic at about 15 billion. So it's that side, that part of the market which is feeling the stress. But let's talk about why they were outliers. Skip to the far right. You'll see the percent of their deposits which weren't FDIC insured, because of the clients that they were targeting. They didn't have a diversified client base. People were putting large amounts of money that was uninsured. And so that's why those depositors were at risk. And so when they started to go for their money, because the rates were higher, the assets, the safe assets of those banks had, which are bonds, treasury bonds, agency bonds, Fannie, Freddie Mae, as well as mortgage-backed securities, had large losses, which if we go third column from the right, you can see the percent of their losses of those two firms. Silicon Valley was over 100%. Signature wasn't that large of losses, but the same comment to the far right, they had lots of uninsured assets. Moreover, look to the left of those losses, money was coming out. People, and this is true of many banks, because you can get more money now at a money market than some of those savings rates, which are still very low. People were pulling money from the bank. So when a run on the bank happens, you know, it's going to crush any bank. So that's why the Fed and the Treasury and the FDIC stepped in with a large, strong facility that should stop that. But meanwhile, it's making the rest of the world and the stock market say, well, what are the implications? What does this mean? So all banks around the world are really staring, especially the smaller ones, and saying, how can we deal with this? So what's the impact? Well, going forward, first off, it does mean that credit is going to tighten, which is also going to slow down the economy as well as bring down inflation. Also, as a result, it's making central banks around the world question, should I keep raising rates as high as I do? In fact, tomorrow, the European Central Bank, the ECB, was planned, pre-announced, to be very blunt, that they were going to raise rates by 50 basis points, a half a point tomorrow. Well, with all the stress going on in European banks now, and Credit Suisse in particular, we'll see tomorrow if the ECB rethinks that, or whether they come out strong and keep doing that 50 basis point, or maybe do something different. Likewise, the Fed, in a couple of weeks, on the 22nd of this month, everyone thought just a week ago that they might actually raise rates higher. They were doing quarter point raises, that they might go back up to a 50-point basis. Jury's out now. Most people say 50 points won't happen. It'll either be a quarter point, or maybe there might not even be a raise. Maybe it'll make them consider pausing now. In fact, if you look at Wall Street, half of Wall Street is kind of screaming at the Fed, saying, you got to stop, you're causing too much stress. And the bigger banks, which are already prepared for this, are saying, no, go ahead, we got to knock this out, inflation. On a political front, it means obviously more regulation is going to happen on the smaller banks. And so that whole part of the industry is going to be re-swizzled over time with bigger regulation, and you'll see more and more complaints about bailouts. So that's the bad news situation and what's roiling the markets right now. It's caused another 5% downdraft. Just a quick comment. We've said for a long time, we're range bound with the S&P 500 somewhere around 4,000. And we can fight to get above it, and we get a little bit above it, but we seem to always draw back. As we speak today, we're under 3,900, or about 3,880 at the moment. So there's about a 5% swing above or below that 4,000 level, which really is our fair value, given the current state of profits and the current high rates that we have. But we are making progress, is the key point we want to get to you on inflation. This is the 8th straight month that inflation has gone down, both from a CPI, the Consumer Price Index, which we all look at, as well as what the Fed's measure of inflation is, the PCED, the Personal Consumption and Expenditure Deflator. And on this chart on the right, you'll see CPI is that blue number, and it was on a high of 9% on a trailing one-year basis last summer, and it's fallen all the way down to 6% now. And the green line is the one the Fed looks. It was like in the sixes, and now it's down in the fives. So inflation is on its downward arc. More importantly, I want you to look at the red line that you see there. That's the one-year future expectations of where inflation will be. And it's even deeper than where we're at. It's all the way down in the low fours. So progress is being made. And in fact, the February numbers that we show were basically on expectations. Looking backwards, we fell from a 6.4 on headline inflation down to 6. On the core, it went from 5.6 down to 5.5. And if you just want to summarize it, all the inflation on goods are under control and very much on target. It's the services side of the economy where we're still not back to normal. The healthcare, travel, leisure side of things, where and rents in particular, where we're seeing the growth hasn't peaked and turned down yet. Another good news situation is that the average hourly earnings have fallen and continues to fall. So that's the scoop. So just to summarize, banking took a shot, the small banks. The Fed has already stabilized and done things for it. We believe it'll be more than enough to not let this contagion spread. But in the meantime, whether it's in the emerging markets, Japan, or over in Europe, those other countries are having to figure out, do they have to take action? Because this is jittering in the market, we are probably going to use more and more of what we've called buffered solutions, things that give us extra downside protection. So in our next video update, we want to do a quick refresher for you all so that you'll know. But basically, we're going to be trying to give you an additional downside protection in the portfolios while still giving you upside protection. So stay tuned, that'll be coming soon. Take care. We'll keep our eye, black as it is, on the markets for you. Take care.